Namaste and welcome to course number 3, that is Technical Analysis. I am your financial guide from Fintemen. If mutual funds are the wealth building engine for most investors, technical analysis is the precision tool for traders and serious investors. It is the science of reading price charts, understanding what is happening inside a market before it becomes obvious to everyone else. In 14 modules, we will go from the basics of candlestick reading all the way to Fibonacci retracements, momentum indicators, chart patterns, multi-time frame analysis, and building your own complete trading system. This course will permanently change how you see a price chart. Let us begin. Here is your roadmap. Module 1 and 2 covers the foundation, like what technical analysis is and how to read charts. Module 3 and 4 go deep on candlestick patterns and the most important concept in all of technical analysis, support and resistance. Module 5 and 6 covers trend analysis and moving averages. Module 7 and 8 adds volume and momentum indicators like RSI and MACD. Module 9 is Bollinger Bands. Module 10 is Fibonacci retracements. Module 11 and 12 covers chart patterns and advanced candlestick combinations. Module 13 teaches the professional multi-time frame system, and Module 14 puts everything together into a complete trading system. Let us start. Module 1 is technical analysis versus fundamental analysis. Before you learn the tools, you need to understand the philosophy behind technical analysis. Let me give you that foundation right now. Technical analysis or Takniki Vishleshan in Hindi is the study of past price and volume data to predict future price movement. It is based on three core assumptions. Assumption number 1 is price discounts everything. All available information like company fundamentals, macro data, geopolitical events, market sentiments, etc. is already reflected in current market price. You do not need to analyze earnings reports separately. The price charts already has that information priced in. Assumption number 2. Prices move in trends. A trend in motion tends to continue until something significant forces it to change. This is the golden rule. The trend is your friend. Trade with trend, not against it. Assumption number 3 is history repeats. Human psychology, fear and greed creates the same patterns in markets again and again across centuries. The same chart patterns that appeared in 1920 appears today in Nifty charts because human nature does not change. These three assumptions from the philosophical foundation of everything you will learn in this course. Technical analysis and fundamental analysis are not rivals. They are partners. Let me show you the key difference and how to combine them. Fundamental analysis asks, what is this business worth? It uses PE ratio, EPS, ROE, balance sheet analysis, etc. Its best use is selecting which stocks to buy, but it cannot tell you when to buy. Technical analysis asks, where is the price going? It uses charts, volume patterns, and indicators. Its best use is timing your entry and exit, but it cannot tell you whether the underlying business is good. The professional approach. Use fundamental analysis to identify great businesses worth owning. Use technical analysis to find the optimal entry point. ideally at a support level with momentum building. This combination is significantly more powerful than either approach alone. For example, imagine you analyzed HDFC Bank and decided it is a great business. Fundamental analysis says buy. Now, technical analysis tells you the best price level to buy at, near its 200-day moving average or at a key support. That is the combined power. Before any indicator, any oscillator, any pattern, you must understand price action. Price action is simply the movement of price over time. And the most fundamental price action concept is this. A trend is defined by the sequence of highs and lows. An uptrend is a series of higher highs and high lows. Each new rally goes to a higher level than the previous rally. Each pullback stays above the previous pullback low. This is the textbook definition of a bull market. A downtrend is a series of lower highs and lower lows. Each rally fails at a lower level. Each decline makes a new low. This is a bear market. Sideways or consolidation is when highs and lows are roughly at the same level. Price is coiling, energy is building, and a big move in either direction is coming. Let me tell you the rule. Only buy in an uptrend. Only sell short in a downtrend. In a sideways market, wait for the breakout before committing. This single rule, followed consistently, will improve your trading results dramatically. Let us now look at the different types of charts and how to read each one in Module 2. Module 2 is chart types. Line charts, bar charts, candlestick charts. Each one tells you a different story. The one you choose matters. Let me show you why. The three main chart types. Line charts connect only closing prices. They give you the cleanest view of overall trend, ideal for long-term analysis or comparing multiple instruments. But they hide all the intraday action. Bar charts show all four prices: open, high, low, and close. Each bar is complete picture of one time period. They are more detailed than line charts but harder to read quickly. Candlestick charts show the same four prices as bar charts, but in a visually superior format. Green or white candle means the close was higher than the open. Buyers won. Red or black candles means the close was lower. Sellers won. The color coding makes pattern recognition dramatically faster. My recommendation for all traders: use candlestick chart as your default. Switch to line charts only when you want a clean trend view without the noise. Time frames: which one to use? The time frame you choose determines the story the chart tells you. A 1 minute chart and a weekly chart of the same stock look completely different and are used for completely different purposes. 1 minute and 5 minute charts are for day traders who enter and exit within the same session. High noise, fast moves requires constant attention, not suitable for working professionals with day jobs. 15 minutes and 1 hour chart suit swing traders who hold positions for 2 to 10 days. Better signal to noise ratio than intraday charts. Daily charts are the most commonly used by retail investors and positional traders. One candle equals one full trading session. Clean, meaningful signals. This is where I recommend most learners start. Weekly and monthly charts are for trend identification. The weekly chart cuts through daily noise and shows you the bigger picture. Always check the weekly chart before making any investment and decision on the daily chart. Before every trade, look at 3 time frames: weekly for trend, daily for setup, hourly for precise entry. We cover this in detail in Module 13. Now, let us move forward to reading a candlestick. Every candlestick is a complete battle report between buyers and sellers for one time period. Let me decode every part of it. The body of the candle, the thick rectangular part, represents the range between the open and the close. A tall body means a decisive move in one direction. Buyers or sellers dominated the entire session. The wicks, the thin lines above and below the body, shows the extreme prices reached but not sustained. A long upper wick means buyers pushed the price up aggressively, but sellers came in and pushed it back down. A rejection at higher prices. Bearish signals at resistance. A long lower wick means seller pushed the price down aggressively, but buyers stepped in and strongly brought it back up. A rejection at lower prices. Bullish signal at support. The most important insight is the wick tells you where price was rejected. Where price was rejected is where strong opposing interests live. At a support level, long lower wick tells you buyers are defending that level aggressively. At resistance, long upper wicks tells you sellers are very active there. Now let us learn the specific candlestick patterns that signal reversals and continuation in Module 3. Module number 3 is candlestick patterns. Japanese traders developed these patterns in the 1700s for rice trading. They work today in Nifty, Bank Nifty, and every global market because human psychology has not changed. Let me teach you the 12 most powerful ones. Reversal patterns. Bullish reversal patterns appear at the end of a downtrend. They signal that sellers are exhausted and buyers are taking control. Here are the 4 most important ones. The hammer, a small body at the top of a candle with a long lower wick, at least 2 times the body length. Sellers pushed the price down hard during the session, but buyers came in aggressively and brought it almost all the way back. After a downtrend, a hammer at support is a strong buy signal. Wait for the next candle to confirm green before entering. Bullish engulfing, a large green candle that completely engulfs the previous red candle. Buyers overwhelmed sellers in one session. One of the most reliable reversal signals, especially with above average volume. Morning star, a 3 candle pattern. Red candle followed by a small body candle that gaps down, followed by a large green candle. Classic bottom reversal. Volume on the 3rd green candle is the confirmation. Piercing line. A red candle followed by a green candle that opens below the previous low but closes above the midpoint of the red candle. Buyers reclaiming lost ground. The golden rule for all bullish reversal patterns is they need 3 confirmations. 1. The pattern must appear after a clear downtrend. 2. It must appear at a key support level or moving average. 3. Volume must be above the average. 3 confirmations equal a high probability trade. Bearish reversal patterns appear at the end of an uptrend. They signal that buyers are exhausted and sellers are taking over. The shooting star. A small body at the bottom of the candle with a long upper wick, at least 2 times the body. Buyers pushed the price up aggressively, but sellers violently rejected the highs. After an uptrend at resistance, this is a strong sell signal. Bearish engulfing. A large red candle that completely engulfs the previous green candle. One of the most reliable bearish reversals. Strong sellers overwhelming buyers. Evening star. The mirror image of morning star. 3 candles. Green, small gap of body, large red. Classic top reversal. Volume on the third red candle is critical. Hanging man. Looks identical to a hammer, but it appears after an uptrend, not a downtrend. Context is everything. The same pattern means opposite things depending on where it appears. Always identify the trend first, then the pattern. The doji family. A doji is a candle where the open and close are almost equal, creating a tiny or non-existent body. It represents indecision. Either buyers nor sellers could establish dominance for that period. Standard doji. Standard doji equal wicks on both sides. Pure indecision. The next candle's directions gives you the resolution. Gravestone doji. Open and close at the bottom with a long upper wick. Buyers tried to push up all the sessions. Sellers dragged price all the way back to the open. Bearish at high. Dragonfly doji. Open and close at the top with a long lower wick. Sellers tried to push down all sessions. Buyers brought it all the way back up, bullish at lows. Long-legged doji. Long wicks on both sides with the tiny body. Extreme indecision. Very high probability reversal if it appears at a key support or resistance level. Remember, a doji after a strong uptrend says the bulls are running out of steam. A doji after a strong downtrend says the bears might be done. Context, where the doji appears, is everything. Pattern reliability scorecard. Not all candlestick patterns are equal. Let me give you a quick reliability ranking. 5-star patterns, highest reliability, are bullish engulfing, bearish engulfing, morning star, and evening star. These work 70% or more of the time when confirmed with volume at key levels. 4-star patterns are hammer, shooting star, 3 white soldiers, 3 black crows, etc. Very reliable but need confirmation candle. 3-star patterns, doji, piercing line, dark cloud cover, etc. Useful as alerts but require additional confirmation before trading. The takeaway is focus on 5 stars and 4-star patterns. Master those 8 patterns thoroughly before worrying about the rest. Now, the most important concept in all of technical analysis is module number 4, support and resistance. If you master only one concept from this entire course, make it this one. Support and resistance are the foundation of every successful trading strategy. What are support and resistance? Support is a price floor, a level where the stock has bounced upwards multiple times. Buyers consistently step in at this level because they see it as value. Every time price touches this levels, buyers appear and push it back. Resistance is a price ceiling, a level where the stock has repeatedly reversed downwards. Sellers consistently appears at this level for booking profits, adding short positions. Every time price touches resistance, sellers appear and push it back down. Why do these levels work? Because human memory is long in markets. If you bought Reliance at 2,400 6 months ago and it went up to 2,800 and then came back to 2,400, you will buy again at 2,400 because you know it bounced last time. Multiply this by thousands of market participants and you get a support level that becomes a self-fulfilling prophecy. The strength of a support or resistance levels is determined by how many times price has respected it and how much volume was present at those touches. 3 or more touches with high volume equals a very strong level. Types of support and resistance. Not all support and resistance levels are equally strong. Here is how to rank them. Horizontal levels are the strongest. A flat price that has been respected multiple times. Draw these as horizontal lines on your chart. When a horizontal level aligns with a round number like Nifty 20,000 or Reliance 3,000, it becomes even more powerful because psychologically significant levels attract more attention. Trendline support and resistance are dynamic. The level changes each day as the trend line extends. These are the diagonal lines you draw connecting swings high or swing low. Moving average support. The 50-day and 200-day moving averages act as dynamic support in uptrends. Major indices and equality large cap stocks often bounce off the 200-day moving average during corrections. Previous swing highs and lows are also significant. The last major high is natural resistance. Traders who missed selling at the high will look to sell when price returns there. The last major low is natural support. Buyers who missed buying look for second chance. Role reversal. This is one of the most powerful and most profitable concepts in all of technical analysis. When a support level is broken with high volume, it transforms it into resistance. Price comes back to the test the old support, and now sellers appear at that exact level. The old floor has become a ceiling. When resistance level is broken with high volume, a breakout, it transforms into support. On the next pullback, buyers appear at the old resistance level, treating it as a floor. Let me give you a real world example. Nifty had resistance at 18,000 for almost a year. Price kept getting rejected there. Then it broke above 18,000 on very high volume. The next time Nifty pulled back to 18,000, it bounced perfectly. 18,000 had transformed from resistance to support. Traders who understood role reversal bought the pullback to 18,000 with a clear stop loss just below it. Beautiful. High probability trade. What role reversal setups are among the cleanest, highest probability trades available. Watch for them constantly. Drawing SR correctly. Most beginners draw support and resistance levels incorrectly. Here is the professional approach. Use closing prices as your anchor, not wicks. Wicks are noise. The body and close represent where real money was committed. Draw zones, not lines. Support and resistance are not precise to the decimal. Draw a rectangle that represents a zone of 0.5 to 2% around the key levels. Price rarely turns at an exact number. Use the weekly chart for major levels. Daily SR can be minor noise. Weekly SR is where institutions trade. These are the levels that define major market turning points. And critically, only draw 3 key levels on any chart. If you have 20 lines on your chart, none of them matter. Identify the most important support and most important resistance, plus the current price zone. That is all you need.